Well, just when you thought the bond rally was about to end, we get a new jobs report and a 9.7% unemployment rate. Treasuries falling for a second day ahead of next week's sales of $70 billion in notes and bonds. But there are some who see, because of the economy, 10-year yields falling as low as 3%. So where to turn to put yield in your fixed income portfolio? Kristen Seva manages $1 billion in assets at Payden and Regal Investment, and a fair amount of that goes into emerging markets. Welcome, Kristen. Tell us, obviously you're going to get a lot more yield in emerging markets. Is that what your main reason for doing that?
Well, I think you're getting a lot more yield than you are in a lot of developed country bonds. As you mentioned, many people see U.S. Treasuries going to 3%. You're not getting much in Euroland or in Japan. So I think within the emerging markets, you're getting 7 to 8% type of yields. And it's also a very high-quality asset class when you compare it with high-yield bonds, for example. It's almost investment grade. 50% of the asset class is investment grade. And these countries have made a great amount of political and economic reforms over the past 10 years. So it's a way to gain yield into your portfolio without having to take on a whole lot of additional risk, in our opinion.
So you're putting most of your money into sovereigns then?
That's right. We take an approach which is primarily sovereign-focused. There are emerging market corporates. We use those opportunistically. But we like the sovereign aspect because we think it's an important diversifier. If you look at what a lot of investors have added over the past several months into their portfolios, because you've seen attractive valuations in high-yield bonds, in investment-grade corporates, or even in equities, all of that is corporate risk. So we see the sovereigns as really a way to diversify. Investing into a country is a very different risk profile than investing in a corporate bond. We also think that default rates within the emerging market sovereigns will stay low. They'll stay less than 2%, whereas you'll see default rates in the corporate space in the high yield be up to 14 to 15% potentially next year.
Well, how much of my portfolio then do I want to assign to these sovereigns in emerging markets?
It really depends on your time horizon, but our clients typically, with a longer time horizon, look at putting anywhere from 5 to 15% of their fixed income allocation into emerging markets at this point of time. I think in terms of valuations, at our portfolio, as I mentioned, is yielding about 8%. And clearly, the emerging market debt asset class has rallied along with all the other credit markets over the past 6 months. So you're not getting in at the lows, but at 450 basis points over U.S. Treasuries, still you're a far cry from 150 at the tights that we saw in 2007. In fact, you're at levels that you haven't seen for the past 5 to 6 years. And within that 5 to 6 years, the asset class has really improved in quality. So you're getting the same spread as you were 5 to 6 years ago for a higher quality asset class because of these improvements, both politically and economically, that these countries have made.
All right, Kristen Seva, please stay with us. We're going to have much more on this topic of putting some money into higher yielding sovereign, for the most part, debt in emerging markets. How much risk should you be prepared to take on with that, though? And which countries offer the best opportunity? Those questions for Kristen coming up next. And stick around. The unofficial end to summer is here. We're going to go to the movies. Considering whether to add emerging market bonds to your portfolio, which countries should you consider? Our guest makes the point that some emerging markets are a higher quality asset class than the U.S., Germany, or Japan. Let's find out why. We're talking with Kristen Seva, head of the global bond area at Payden and Regal. Thank you very much for sticking around with us. Tell us some of the countries that you like and why you think they are such a low risk.
I think in general, many of the emerging market countries, particularly in Latin America and Asia, haven't had the same level of leverage in their banking systems. And I think that they've also been able to lower their levels of debt to GDP. So you contrast that with what's going on in the developed markets in terms of leverage in the banking systems and skyrocketing debt to GDP levels and fiscal problems. You really have the notion of emerging markets being so risky turned on its head. In terms of specific countries that we like, regionally we like Latin America and Asia. We're slightly underweight the Eastern European region because that is a bit of an exception to the rule in EM in terms of the leverage of the banking systems. There were some countries in Eastern Europe that were a bit more levered that might have some problems in terms of potential growth going forward. But within Latin America and Asia, I think there's a lot of strong considerations there. We like Brazil, particularly the local markets in Brazil, meaning buying a Brazilian bond denominated in real, the local currency, which is yielding about 12%. That's a core holding within our portfolio. We think inflation's coming down. The central bank has done a good job at being able to lower interest rates there. We also like some of the smaller countries in Latin America, like Dominican Republic, which is yielding 10%. It just recently got a deal from the IMF, and as you probably have heard, the G20 has given lots of extra money, $750 billion now, to aid different countries in emerging markets through the IMF. So I think that that's been a strong source of support to some of these smaller sovereigns and has responded well in terms of markets.
Do you buy most of your bonds in the local currency? You brought that up with the real, or dollar-denominated bonds?
Most of ours are dollar-denominated bonds, and then we add the local markets opportunistically where we see value, both from the rate side in terms of what we think is going on with interest rates, and also where we think there's a strong currency appreciation potential. So we are denominated primarily in U.S. dollars, and then we'll go up to about 30% potentially in the local markets. And those local markets are also sovereigns, so another way to gain additional yield into the portfolio, but still dealing with higher quality sovereign risk.
You said you do buy a few corporates. What kind of corporates do you look for in these emerging markets?
We look at corporates where you're earning a yield above the sovereign, but you're still with a higher quality corporate bond. There's a lot of what we call quasi-sovereigns that are 100% government-owned, like Gazprom, for example, in Russia, where you're earning a healthy spread above the Russian sovereign, but you're still getting a 100% owned type of company. We've also been adding some corporates where we just see higher quality management. We're not getting into the very distressed level of corporates where you'd have to go into potentially legal ramifications and that sort of thing.
Yeah, Bloomberg just ran a story today that we're seeing a tail off in people buying the higher risk, higher yield corporates in emerging markets, but they issued, I think, a tremendous amount over the last 6-7 months, and I'm just wondering what the attraction there is. Have emerging markets gotten a little bit safer?
Yeah, I think within the past 6 months, people feel that emerging markets have passed the test. I think at the end of 2008, many people were worried that with all the global volatility and would there be another emerging markets crisis. And in previous emerging markets crises, you had devaluations of currencies of up to 500%, countries having to hike interest rates substantially to control that. But within the last 6 months, I think people have felt much more comfortable that this hasn't been an emerging market crisis. There has been some currency depreciation. It's been very controlled. And unlike periods in the past, this time around, countries within the emerging markets have actually been able to lower interest rates, to be able to do some counter-cyclical policies, which have really gotten them through this with flying colors. And again, with lower current account deficits and really lower debt to GDP than many of the developed countries. So I think people feel much more comfortable with the asset class. But I do think within the corporate space, you have to be very careful, as your previous guest mentioned, in picking companies that have very strong transparency and corporate governance.
All right. Well, good advice, Kristen Seva. Thank you very much. You might want to consider emerging market bonds in your portfolio.